Banking Association of Panama, World Compliance Association, International Fiscal Association members, colleagues, and all of our guests, welcome on this beautiful morning in Panama City, Panama. My name is Amanda Barraza de Wong, board member of the Panama chapter of the International Fiscal Association, and it's my privilege and pleasure on behalf of the coordination team of this webinar to welcome you here today. We are delighted to have you with us to participate and share a technical journey on reporting requirements in connection with trusts, FATCA, and CRS. Thank you for attending. That many of you have registered pretty early, that we have had sessions organizing specific challenges this topic brings, serves as a reminder to us all just how important working as a team is. World Compliance Association has invited the Panama chapter of the International Fiscal Association to jointly offer this event tailor-made for our Banking Association of Panama colleagues. Our mission is to provide practical and technical discussion on such a trending topic. We are honored to have Peter Cotorcianu and Laura Barrios as keynote speakers with us today. Both are esteemed specialists and tax treaty experts. Thank you very much for your valuable support. And before I hand over to Laura Barrios, I want to say once more on behalf of the coordination team, welcome. It's wonderful to see so many of you here today. Laura?
Thank you, Amanda. I just wanted to say that I'm delighted to have Peter with us. For you that are joining us that do not know it, Peter is the world-leading expert in advice to financial institutions with respect to trust and the obligation of trustees. He is the creator of a website that is called FATCA and Trust that you are going to see at the end, the website, and he advised financial institutions around the globe with regards to CRS and FATCA, and also with US cross-border tax advice. So Peter, welcome. We are very happy to have you, and we are going to start with the presentation. I don't know if there is going to be any explanation with the translation, but otherwise we are going to start right away. I'm going to share my screen for you to see our slides and be able to continue with the presentation. Welcome all.
Thank you, Laura.
So just give me a second that I have an issue with the sharing of the file of the slides. Just give me 1 minute.
Perfect, Laura.
Okay, so as I said, welcome you all, and we are going to start with a brief introduction of what we are going to discuss. We are going to discuss the role of banks as depository institutions. That means when the bank holds the account on the name of a trust, and when banks act as trustees or other entities act as trustees. These are two separate functions that the financial institution has. One as the depository institution, and other will be as an investment entity that administers funds for third parties. So we are going to treat them in two separate parts. First, we're going to discuss the banks as depository institutions when they have a trust as the account holder. We are going to talk about that about 40 minutes, and then we are going to leave a space for questions and answers. I'm going to ask you all, the participants, to please put your questions in the Q&A board that you have in the webinar, because we are going to discuss them in a 50-minute period after we finish the first topic. And then we are going to go to the next topic, and we are going to see the obligations of trustees with respect to trust in FATCA and CRS. And then we are going to give another space for you to put your questions, and we are going to discuss them live. So please feel free to put all your questions in the Q&A section. So which are the FIs? All banking institutions, depository institutions, and trustees, which are all the obligations that all FIs have according to Panamanian regulations. Well, the first one is that they have the register at the competent authority as an FI, as a financial institution. The second one is that they have to perform CRS and FATCA due diligence. This due diligence for FATCA purposes is in Law 47 of 2016, and for CRS purposes is in the Executive Decree 124 and its modifications. So that will be the second obligation, is a broad one. And then they have to establish policies according to the regulations to comply with report obligations. This will mean that they need to include their procedures that they are applying for FATCA and CRS purposes in their compliance manuals. They have to submit FATCA and CRS reports that they have to maintain the information obtained for a period of 5 years, and they have a duty of confidentiality. What means this duty of confidentiality? That they can only disclose this information in compliance with the law and the regulations. So, Peter, why is it important for, even if it's not included in our regulations, why is it important for all FIs to establish a compliance program in order to comply with the regulation, and what is this a best practice?
Well, first of all, I just want to say that under the FATCA responsible officer certifications, you have to certify that you've established a compliance program and that you've reviewed it periodically. Now, Panama's a Model 1 IGA jurisdiction, which means that it does not have to do the FATCA responsible officer certifications, but the fact that there's that requirement in there makes a lot of sense, and it should be adopted under FATCA and CRS anyway. It's one thing to have policies and procedures, but people don't often or sometimes don't follow the policies and procedures. And unless you actually have a compliance program to check whether people have been following it and to review that compliance periodically, you're not going to have a robust implementation of these programs. So that's why I put the language there in parentheses, because it's not a legal obligation in Panama, but it certainly is required by best practices.
Okay, thank you, Peter. Then now you see a box of discussion. We are going to discuss some main points that we wanted to outline for the obligations of the FIs. So the first one will be the dates. So there was an amendment to Executive Decree 124 that there is no deadline anymore for Panamanian FIs to register. They can register at any point before the report. There was a deadline before, but there is a deadline for the report, and the deadline is July 31st. So last year, because of the COVID situation, the deadline was extended until September 30. But this year, there hasn't been any extension. So we have to assume that the deadline is July 31st. So besides that, we have the issue that there's no reportable jurisdiction list issued for this year. The tax authority hasn't issued a reportable jurisdiction list. So the banks and all other FIs do not know what additional countries are going to be added for the report. And we are almost 1 month until the deadline. So we will have little time to know which new jurisdictions are going to be added to the reporting obligation. So Panama, and I know that Peter can comment, most of countries that I have seen have an obligation of submit a nil return, meaning that if you do not have any reportable accounts, you need to tell the tax authority in a report that you do not have reportable accounts. In Panama, this is mandatory. But even in the jurisdiction that this is not mandatory, we should assume it as best practices, because that will tell the tax authority that you did your due diligence and you didn't find any reportable account. And I wanted Peter to jump in here and help me with the additional obligations under FATCA that financial institutions has, considering Panama IGA. The main one will be obtain a GIN in the case that the ones that have to obtain it. But Peter, can you like comment on the additional obligations that the FIs has, because we are talking mainly about CRS, but FATCA has additional obligations for FIs.
Yes, certainly, Laura. I mean, I think most people are aware that for FATCA purposes, FIs have various what I call compliance paths. The main one, or at least the primary one, is to register on the IRS GIN registration portal. The GIN is, of course, short for Global Intermediary Identification Number, and obtain a GIN. And then you use that GIN when you fill out the W-8 forms for the financial institutions where you hold accounts. Other possibilities are to be sponsored, and then depending on the type of sponsorship and where the sponsored entity is located and whether there are US persons involved, the sponsored entity may have to get its own GIN, may not. Also for trusts, there's a route called the trustee documented trust route, which under FATCA means the trust doesn't have to get a GIN, but the trustee would have to get a sponsor's GIN. So you just need to be familiar with the fact that under FATCA, there is this additional registration obligation on the IRS website, which of course under CRS, the registrations are all done locally on your country's portal.
Okay, thank you, Peter. We are moving to our next slide, and we're going to talk a little bit about the due diligence and report obligations that the banking institution has as depository institutions. So the main one is that they have to identify account holders. according to the regulations for FATCA and CRS, trusts should be treated as entities. That means that you need to obtain as a best practice a self-certification of the trust, not the trustee, but the trust. You need to identify that your account holder for FATCA and CRS purposes is not the trustee, is the trust itself. Also, you need to classify them, even with a self-certification, or if it's a pre-existing account, you can do it with your AML information. But you need to classify the entity as active, passive, or a financial institution. In this case, since the trust doesn't render services, most of them are not going to render services, the only time that they can be classified as a financial institution if they are a professionally managed investment entity, meaning that the trustee or other financial institution manage the trust assets discretionally. So as entities, if the trusts are NFEs, meaning active or passive non-financial entities, they have to be reported to the residence jurisdiction of the trust. And if the trust is classified as a passive non-financial entity, then you need to identify controlling persons of the trust. Later, we are going to discuss very in detail who are controlling persons for the trust. I know this is one concern that most of you have, how to identify these controlling persons. And this is very important. The trusts that are classified as FIs are non-reportable persons for FATCA and CRS purposes. So in the box of the discussion that I want to comment with Peter, the first one will be wrongly documented the trustee as an account holder. And Peter, we received a question previously to the webinar where some bank or some compliance officer asked if the trustee holds an account, and I know that account is not of the trustee, but one of the trusts that they administer, is it enough for me to document that the trustee complies with all their due diligence and all the reports for FATCA and CRS? And I will say that no, really, you do need to document the trust itself as an account holder, and that this is very important. So what are your comments on this, and why is this is so common? Because the account is open on the name of the trustee, but the banks need to identify that that account is an account that is held by a trust, and the trust needs to be classified as an independent entity from the trustee for FATCA and CRS purposes.
No, you're absolutely right, Laura. And the reason it's not enough just to rely on the trustee is because unless you know what type of entity, in other words, financial institution, passive NFE, or active NFE, unless you know the classification of the trust, you don't know what the trustee's obligations are. If the trust is a financial institution, then yes, the bank can rely on the trustee, in fact, must rely on the trustee to fulfill the obligations, the FATCA and CRS obligations of the trust. But if the trust is a passive NFE, then as we'll see, it's the bank's responsibility to identify the controlling persons and to report them as appropriate. And also, depending on where the trust is deemed to be resident, perhaps report the trust as well. And if the trust is an active NFE, then to report the trust, no, not controlling persons, but the trust, if the trust is resident in a reportable jurisdiction. So the bank just can't wash its hands and say, well, it's up to the trustee, they're a financial institution. It's the trust itself, as you pointed out, which is the account holder. And depending on the classification, the trustee may not have any obligation to do any FATCA or CRS reporting. The bank may. So no to the suggestion that the bank can simply relax and not do anything if the account holder is a trust.
Okay. So now that you mentioned that if it is a non-financial entity, it has to be reported to the resident jurisdiction. So where is the jurisdiction that we should take as the trust jurisdiction if the trust has no tax residence? Because we could decide that is the applicable law of the trust or the trustee jurisdiction that is the most acceptable that have been used for trusts or RFIs. But if the trust is a non-financial entity and is and I have to report it to its tax jurisdiction, if the trust doesn't have any tax residence, what jurisdiction should the banks take at the most likable to be the trust jurisdiction, the trust tax residence jurisdiction?
That's a very good question because CRS is very clear as to where a trust is resident if the trust is an FI. And in that context, of course, residence is relevant because the trust as an FI has potential reporting obligations and it has to know which jurisdiction to report in. So if the trust is an FI, CRS is very clear. The trust is resident where the trustee is resident, unless it's tax resident somewhere else and reports somewhere else. But most trusts that we deal with in the offshore world don't have a tax residence because they don't pay taxes. So if the trust is an FI, it's resident where the trustee is resident. However, CRS is very unclear as to where a trust that is an NFE is resident. The trust itself won't have any reporting obligations because only FIs have reporting obligations. But where does the bank where the account is held report the trust? Where does it treat it as resident? Again, CRS is not clear. In my view, the governing law should be irrelevant and you should report where the trustee is resident. That makes the most sense because that's where the trustee is subject to the jurisdiction. That's where if there's an issue, the local government of the trustee's country can reach out to the trustee. The law of the jurisdiction of the trust really doesn't make a lot of sense to report there. And one example is, for example, and you know this, Laura, for sure, Switzerland, there are many trusts with Swiss trustees, but Switzerland doesn't have a governing law of trust. So any trust with a Swiss trustee must borrow the law of some other jurisdictions. And sometimes they borrow BVI law, Jersey law, Guernsey law, Bahamas law, wherever. But if you have a trust with a Swiss trustee, I would say treat that as resident for CRS purposes in Switzerland and report there, not where the governing law is, because Jersey, Guernsey, Bahamas will not have even heard about this trust, won't have any knowledge of it. So that's sort of a long-winded answer to your question.
Yeah, no, I completely agree. The most likely place will be the trustee jurisdiction because there is some enforcement there for the trustee. So there will be some enforcement with the compliance of the trust, and it's any other obligation that can arise from the report. So in the last part that we are going to discuss in this slide, I just wanted to have your input, Peter, as an expert also in US law. What we see clients and the banks always or sometimes they contest the classification of the trust in the W8 forms. The client probably doesn't know why it's relevant to classify the trust as simple, complex, or grantor trust. We already discussed that this is not relevant for FATCA purposes, but since a lot of banks also have other obligations as qualified intermediaries, they sometimes contest the classification that you include in the trust for this purpose. So just for clarification purposes, I just wanted to point out that this is not relevant for FATCA or CRS, but since it is included in the W8, then they need to know why the bank is is contesting, and also that the banks need to be aware of the correct classification of the trust, since considering their quality.
Yeah. So there are a couple of issues here. One is, how do you classify a trust as simple, complex, or grantor? And this isn't really the forum to get into that technical discussion. I have a flowchart on my website that goes through this step by step so that you can classify your trust. It's a subscription-based website, so you'd have to subscribe to get access to that. But the reality is that, as you've mentioned, Laura, the simple, complex, and grantor trust classification is not relevant for FATCA. All you need to know is it a trust? Is it an FI? Excuse me, is it a passive NFE? Is it an active NFE? However, the W8 form has that, on there. So the instructions for the W8 make very clear that if the only purpose for which you are submitting a W8 form is for FATCA and not for QI or US withholding tax purposes, then you can submit a W8 BNE. Let me explain that a little bit. Normally, if you've got a grantor trust or a simple trust, these are flow-through trusts for US tax purposes, you have to submit a W8 IMY. IMY stands for intermediary, and because simple and grantor trusts are flow-through and therefore intermediaries, you would typically have to file a W8 IMY, not a W8 BENE. However, those rules are only relevant if the trust holds US securities, because then you need to determine if it's flow through, what the withholding tax rate is for the beneficial owner. For FATCA, if there are no US securities in the account, you are allowed to submit a W8 BNE, regardless of whether it's simple, complex, or grantor. And you can write across the top of the W8 BNE for FATCA purposes only. And as long as there are no US securities in the account, the bank should accept it. However, in my experience, banks don't like that. They want an IMY, a W8 IMY, if it's simple or grantor. And the reason they do is they say, well, it might not have US securities now, and it might even be blocked for US securities, but what happens if in the future it has US securities or is unblocked for US securities? Then we'll need the IMY, and we don't want to have to go and get it then. We've got your attention now, we want it now. So again, somewhat of a long answer, but the reality is, even though simple, complex, and grantor are not relevant for FATCA purposes, the banks are going to want you to classify them and may demand a W8 IMY for the simple and grantor ones. I hope I haven't confused too many people with that sort of long answer.
I just wanted to point out the conclusion is that the bank could, for FATCA purposes, only use the W8 BNE if they would like to. So that's an option that exists. So that's what I wanted. That's the message that I wanted to send to our compliance officers that are working on banking institutions or any other financial institution that require this. So
yes, that's right. And it's interesting, even though the simple, complex, and grantor trust is not relevant in that context, the form still requires you to fill it out, and the instructions don't say you can leave it blank even though it's not relevant. So that would still have to be ticked, but the W8 BNE would be sufficient.
Okay, thank you. That was very helpful. So we are moving to the next slide, and I will give you the word to you, Peter.
Yeah, this is an important slide because I think there is some confusion where a bank is acting as the depository institution and you have a trust that's an FI. It has to be crystal clear who's responsible for the reporting, and some banks seem to want to report even if the trust is an FI, and I keep telling them, no, you don't have to, but they don't want to just rely on my word. So this slide points to you points you to where in CRS you can rely on the fact that if your trust is an FI, you don't have to report them. And it's in the definition of a reportable account. So if you look at the top bullet point, a reportable account is an account held by one or more reportable persons, and we'll look at that definition in a minute, or by a passive NFE with one or more controlling persons. That is a reportable person. So again, reportable person is important. And then if you look at the next bullet point, who is a reportable person? The important point here, just go down to number 6. First of all, the introductory language. The term reportable person means a reportable jurisdiction person, and we'll come to what that means in a second, other than, and there's the list, financial institutions are expressly excluded from the definition of reportable persons. So are publicly traded companies. So are related entities of publicly traded companies. And you can read the rest of the list for yourself. But the important one is financial institutions. And a reportable jurisdiction person is just an individual or entity that's resident in a reportable jurisdiction. So if you have an entity resident in a reportable jurisdiction, and if it's an FI, it's not reportable. So there's the language from CRS. Be very clear that if you're a bank and if your account holder is a financial institution, you have no reporting responsibilities. There's one exception to this, and we'll look at it later, and it's where the account holder is a professionally managed investment entity in a non-participating jurisdiction. Then you have to treat it as a passive NFE. But subject to that very narrow exception, if your account holder is an FI, the bank can wash its hands, and then the obligation to report falls on the account holder. Now, here's a question about what happens if the account is held by a passive NFE trust. And maybe before we get into this, we should just make sure, for completeness sake, what if it's held by an active NFE trust? Some trusts will be active NFEs, and there's no point getting into when and where, but especially if they're owning operating companies, they might be active NFEs. And there's a debate around if they don't have any income at all, maybe they could be an active NFE. But if the trust is an active NFE, of course, there's no look-through for controlling persons. The trust itself is reportable if it's resident in a reportable jurisdiction. So don't forget trust as active NFEs. But if the trust is a passive NFE, there are two things to consider. One is the trust itself is reportable if it's resident in a reportable jurisdiction. And as we mentioned earlier, treat it as resident where the trustee is resident. And then, of course, you have to report the controlling persons if they are resident in a reportable jurisdiction. And the definition of controlling persons, this is from the Panama regulations, decree, I think you call it, Laura, executive decree. So the controlling persons of a passive NFE trust are the settlor, the trustee, the protector, if there is one, the beneficiaries or classes of beneficiaries, and any other natural person exercising ultimate effective control. And we'll come back to that language later on, especially in the context of account holders if the trust is an FI. Panama has chosen an option that CRS gives it with respect to beneficiaries, and it's the highlighted language at the end. If you have a discretionary beneficiary, then you do not consider them a beneficiary or reportable except in years in which they receive a distribution. And in many other countries, it's optional with the bank to decide whether it wants to just report discretionary beneficiaries who get distributions or all beneficiaries. But in Panama, as I understand it, in your decree, a bank is only allowed to report beneficiaries who are discretionary beneficiaries in the year they get distributions. But how will a bank know if the trust has made a discretionary distribution? It might know it if it's also the trustee, but if it's not the trustee, how will it know it? So there is an obligation for the bank to put in place procedures to ensure that it will be informed when a distribution is made to a discretionary beneficiary. And that's also included in that highlighted language there. And here, what I would suggest is that in the self-certification form that you get from the passive NFE trust, you include language whereby the passive NFE agrees to inform you when a distribution is made. And that's how the bank will be able to determine when a discretionary beneficiary has to be reported.
Yes,
one last thing about, can I just make one last point about that slide, which is that all protectors and trustees are reportable as controlling persons. But also bear in mind that controlling persons must be individuals. So if the trustee is an institution, then the institution is not reportable. You're always talking about individuals when it comes to controlling persons.
Okay, so we are going to the discussion part of this important topic that we just discussed, that about reportable accounts, reportable persons, who are controlling persons when you have a trust. And then we are going to discuss some of the main parts that Peter outlined in the past two slides. So as you said, Peter, in passive non-financial entities trust, settlor protectors and mandatory beneficiaries are always considered controlling persons, even if they do not control the trust assets. Why is this important? Because some banking institutions could only have identified as the settlor, as the person that they consider the ultimate beneficiary for AML purposes. So they probably do not have identified the protector, the beneficiaries, or any other person that exercises ultimate control, for example, the person that has access to the funds. So I just wanted to outline this obligation that they have to consider controlling person of all the actors in the trust, even if they do not have any control of the trust assets. I just wanted to emphasize this because for due diligence purposes, it's very important, specifically if the bank doesn't have the trust deed, it has to ask, is there a protector? Just to be sure that they are identifying all the actors that they are by law required to identify as controlling persons. And well, in passive NFE trust, the trustees are always considered controlling persons, as you said, Peter. And there is a very interesting question is that do we have to look through for corporate trustees? The simple answer will be yes. But what happens when this trustee is a licensed trustee that is a financial institution, even if the trust is passive? Do I need to look through? How do I look through? So this is something that I think it's worth discussing.
Yes, no, I agree with you. And here you have to look at the rules for who are the controlling persons of a company, because you're looking now through the corporate trustee and looking for the controlling persons of the corporate trustee. And under the rules for companies, the controlling persons is sort of a three-layer analysis. One is any person who owns more than 25% of the shares of the company. So if you had 5 equal shareholders, they each own 20%, none of them would be controlling persons. But if you had one or more persons who own more than 25%, then they are a controlling person. And then you would stop there. Those are the controlling persons of the trustee, and therefore they're a controlling person of the passive NFE trust. But if you have no controlling persons at the level of the shareholders because no one owns more than 25%, Then you go to the next level and it says any person exercising control through other means. Well, you may not have other means because it's only the shareholders who are controlling it. You could have some sort of a voting agreement where somebody had voting control who didn't have more than 25% of the shares, but that would be a rare case. So if you don't have a more than 25% shareholder, and then you also go to the next step and you don't have anybody else that controls it, then you go to the senior managing official of the corporate trustee. And they are a controlling person of the trust. It's kind of counterintuitive. Why should a trustee be reported? You should be looking for beneficial owners and people who are tax liable, but that's the way the rules work. Now, as a practical matter, it may not make much difference because if your corporate trustee is resident in Panama, for example, and if all of the shareholders are resident in Panama, and if the senior managing official is resident in Panama, they won't be reportable because they're in the same jurisdiction as the trust. But you can have a situation where the shareholders are in another country. It's not uncommon for a corporate trustee to have shareholders outside of the jurisdiction where it's incorporated. So there can be reporting. But that's how the look-through rule works for corporate trustees.
Okay, thank you, Peter. I think that this is very important because these 2 points are like very connected. Just for the compliance officers and banking institutions, be aware that it's not only the beneficiaries, it's not only the settlor, the one that put the assets on the trust. You also need to look for other actors in the trust, and if they are companies, you need to see through them. So this is a very important message for all the attendees. And well, I wanted to discuss this particularly that Panama has, that as you said, in our jurisdiction, there is an option to treat discretionary beneficiaries, only to treat them as beneficiaries in the year that they receive the distribution. However, in Panama, there is an obligation because the law says that these beneficiaries will only be considered beneficiaries when they receive the distribution. So what does this mean for FATCA purposes? Because FATCA doesn't have this language. So if you have, and I'm gonna put this example, if you have an individual that is resident, is considered a US person, but it's also considered a resident in another reportable jurisdiction for Panama and is a discretionary beneficiary, you probably are going to have to report it for FATCA purposes to the US, but not to its jurisdiction of residence unless he has received a distribution. So I think that that's something that I wanted to have your input on, that how this could be different given the language in Panama's regulations. So, do you hear me, Peter? Are you?
So I heard you, but I was reading a question. So I'm sorry. I was reading a question that just popped up, which is a good question, and we'll get to it later about the corporate trustees. Sorry.
Okay.
What was your question?
So, I was just in the part of that this particularity of Panama regulation could mean that a person with double residence, meaning is a US person, but is also resident, for example, in Colombia, that if it is a discretionary beneficiary, you probably have to report him through FATCA, even if he hasn't received a distribution, because FATCA doesn't have this language, but you don't have to report it to Colombia. So this so this could pose a different reporting for the same individual, for example.
Yeah, absolutely.
So I think that we already discussed this one, the documentation if the participants of the trust are also entities. I think we covered it, that you need to go through all the process of looking through the entities and identifying the controlling persons. And This question is mainly for you, Peter, in this discussion part. Since Panama has this language that you can only treat the beneficiaries of a passive trust as beneficiaries when they receive a distribution, what can the bank do? And I think you already answered it, but I wanted to emphasize it. What can the bank do to be sure that it has that person has received a distribution? What can be done in a best practice way?
Well, there's really only one thing that can be done, which is to require the trustee to inform the bank when a distribution is made, because otherwise the bank has no idea. When money goes out of the trustee's account, the trust account, even if the bank has AML records that identify the beneficiaries and the bank can see that it's being wired to an account of a beneficiary, the bank doesn't know necessarily that it's a distribution from the trust as a beneficiary. It could be, for example, that the beneficiary provided services to the bank, to the trust, and this was a reimbursement for those services rendered. So the trustee must give an obligation or must commit to the bank to tell the bank when a distribution is made to a beneficiary and how much that distribution is. That's the only way the bank can get this information.
So this is something that the banks could include maybe as a separate document or in the same self-certification that the trustee, in the case of a trust, commits to inform the bank of any distribution made to the beneficiaries, so they can cover themselves, so they can cover it. Okay, thank you, Peter. Okay, so the trust as depository institutions can also have an account holder, a trust that is classified as a financial institution in the way of a professionally managed investment entity. And as Peter mentioned, and he was very emphatic on this, if a trust is classified as a financial institution, then the trust will be non-reportable because the account will be a non-reportable account, since financial institutions are non-reportable persons. This was covered by Peter, but I just wanted to point it out and be very emphatic on this because there are many banks that are making the reports still when the trust is classified as a financial institution. So in the discussion part, Peter, I just wanted to discuss, and this is something that you mentioned, what happens with foreign trusts in non-participating jurisdictions? Well, simple answer, this trust needs to be treated as passive non-financial entities trust. So you could have a professionally managed investment entity trust that is managed by a professional trustee, and it has discretion, and it can be classified as an FI. But if it is from a non-participating jurisdiction, you need to treat it as a passive non-financial entity and go through all the process of identifying controlling persons. This is only for trusts that are resident in non-participating jurisdictions, meaning for simple reasons, in our case, will be mainly US trusts. So if no certification is provided, for example, for pre-existing accounts, no certification was provided, how can the bank know if the trust is a professionally managed investment entity? So this is one of the things that I wanted to discuss, like how can they do it? And the question for me, Peter, or the answer for me, Peter, and I'm sure or kind of sure that you're going to agree, is that for best practices, the bank, even if it's not obliged to, they should ask for a self-certification, because otherwise they are going to make an analysis on how the trust should be classified that could be wrong.
That's right. I mean, there are some of the due diligence rules for pre-existing accounts that don't require a self-certification. I always recommend you get one anyway, because I think it's the simplest way to do the due diligence. But let's take a situation where a bank, if there's a discretionarily managed account at the bank, then we know that the requirement for professional, quote unquote, professional management is met. But there's still an income requirement, right? I mean, you still have to get at least half of your income from financial assets. The bank only knows about its bank account. It doesn't know about assets outside. And it could be that an entity a trust that has an account there that is professionally managed gets most of its income outside of the bank and outside of financial assets. So the bank really doesn't have all of the information it needs. Also, let's say you have a trust and the account is not discretionarily managed, and the trustee says that it is a professionally managed investment entity. It may or may not be. It can depend on who has the investment powers. It could have another bank account at another bank that's professionally managed. The trustee could have the investment powers and the trustee could be an FI, but the trustee might not have investment powers. So really the best practice is get a self-certification, and of course make sure you review it to make sure there's nothing that is in your files that contradicts it. So for example, if you're a bank and you have a professionally managed account and they say that they're not an FI, then I would challenge that. They may not be, they may not meet the income test, but you can't just always accept self-certifications at face value.
Yeah, and Peter, I just wanted to point out something here. That the fact that the trust doesn't have a professionally managed account on that particular bank that is doing the due diligence doesn't mean that the trust cannot be classified as an FI, as a professionally managed investment entity, because the trust is classified as an entity, not in each account. So the trust could have other accounts that are managed discretionally and could meet the income test, even if that particular bank that is making the due diligence doesn't have a professionally managed account there. So this is something that I want to emphasize, because some of the banking institutions have the approach that if the account that the trust has in my institution is not professionally managed, then I'm going to dismiss the fact that the trust could be a financial institution. So I just wanted I just wanted to clarify that, and I just wanted to hear your input on that.
No, you're absolutely right. You're absolutely right. You cannot tell just from your account what the institution is, because you don't know if it's professionally managed elsewhere, and even on the income test, you don't know what the income, what the source of the income is.
Okay, so this is a message for all the participants. If you receive a certification saying that the trust is a financial institution, even if the trust doesn't have a professionally managed account in your bank, that doesn't mean that it cannot be treated as a financial institution. That just means that you need to ask more questions in order to satisfy your due diligence. So, and the final point on this topic will be, if the trust has a corporate professional trustee, meaning a trustee that is an FI, that will make automatically the trust an FI. Well, we know that the quick answer is that no, and this is important for you to know. But Peter, I know that you have some comments on why not, why this doesn't happen automatically.
So in order to be an FI, there are two requirements. This type of FI we're talking about, a professionally managed investment entity. And the one requirement that's relevant here is professional management. And some people take the position that if the corporate trustee is itself an FI, then the trust is automatically professionally managed. And I actually think that's a reasonable position, but I don't think it's the only reasonable position. if you look at the commentary under CRS, it says that an entity is professionally managed, or it might be cast in the negative, I don't have the language in front of me, is not professionally managed unless there's discretionary authority to manage the assets.
I'm going to help you here and just jump a little bit in our slides for you to have the exact text in the last point.
There you go. An entity shall not be deemed to be managed by another entity if the entity has no discretionary authority to manage the entity's assets in whole or in part. Now, one view is that a trustee always has discretion to administer the assets. They can decide whether to distribute them in kind. They can decide whether to insure them, and that is discretionary authority over the assets. However, others take a position, equally reasonable in my view, that language is really addressed to investment discretion. And some trusts are what we call directed trust or settlor reserved investment powers trusts, where the trust deed says that the trustee has no investment powers and they're reserved to the settlor. And in that case, if you take the position that professional management requires professional investment decision management, then unless the assets are put into a bank account that's professionally managed, or the settlor delegates professional management of those assets to a third party that's an FI, then you can take the position that the trust is not professionally managed and therefore would not be an FI.
Okay, and this analysis that you're doing is assuming that trust does comply with the income test, because
yes.
From what you said, the trust could have an FI that is the trustee, but doesn't meet the income test. So in that case, it wouldn't be considered an FI.
Right, exactly. Then the professional management question would become irrelevant because it didn't meet the other requirement anyway.
Okay, so that I just wanted to clarify that. Thank you, Peter. And I think we are going to the final slide in this part, and then we are going to answer some questions.
Okay, so this is a sort of a slide that sums up what we've said about controlling persons and looks forward to what we're going to say if the trust is an FI. And so this is where the bank is the depository institution and we have a trust. In the green boxes on the left-hand side, we're assuming the trust is a passive NFE. In that case, the bank reports the controlling persons, assuming that they're in a reportable jurisdiction. It also reports the trust itself, assuming it's in a reportable jurisdiction. So who are the controlling persons? Well, as we've said before, the settlor, the protector if there is one. I've got all beneficiaries. That's the standard definition, certainly under FATCA, under CRS as well. But CRS, as we've said, allows the bank to only report discretionary beneficiaries in situations or in years in which they get a distributions. And in Panama, they have to take that approach. And again, you'll need a procedure if you're a bank in order to determine when a distribution is made. The trustee, and of course, we've talked about the look-through provision for corporate trustees. And one thing we haven't really discussed yet are lenders, because the definition of financial account, at least, includes debt and equity interests. Lenders are not controlling persons.
Just for you to have it. I think that we do have it here in the first one.
Okay. So we have debtor equity interest. I think, I'm not sure if we'd come to this slide yet or if this is one that's coming up.
On the next part, but just for you to have that the wording includes debt and equity. Yeah.
So debt and equity interest holders only applies if the trust's an FI. Remember, if the trust is a passive NFE, controlling persons controls. Lenders are not included as controlling persons. That's why that's in red. Actually, in the other column, as we'll get to later, lenders should be in green, not in red, because that would be a debt interest holder. That was my mistake. I prepared this slide, so apologies there. But certainly on the passive NFE side, lenders are not included as controlling persons. And we're going to come in more detail on the FI side, where the trust is an FI, where the trust is going to be doing the reporting.
Okay, so I guess we are done with this part. As I said at the beginning, we had two parts. You can see it on the slide: bank as depository institutions and bank as trustees. So now, Peter, I don't know if you want to take the two questions that are in the board that are in English, and I'm going to translate the other one. So you can go forward with that one. And I have other questions that are on the other chat. So if you can start with those two, that would be very helpful.
Okay, so there's a question in the chat as well, and I think we should address that one. That one can be addressed relatively quickly, and then we can get to the ones in the Q&A. So the one in the chat says, and I'm just looking at the ones in English because I don't understand Spanish, unfortunately. If it's an FI US trust, then it's reportable for CRS purposes, but not for FATCA. Actually, that's backwards. If it's an FI and it's a US trust, and I'm not talking now about whether it's a US trust for US tax purposes, but if the trustee is in the US, it's not reportable for CRS, the trust itself, because the US is not participating in CRS. The controlling persons would be reportable, certainly if they're in reportable jurisdictions. Now, for FATCA purposes, the trust, if it's a US trust, would be reportable because it's a US person. Now, that here it is important that the trust be a US trust for tax purposes, because you can have, and it's a very common planning device, to have a trust with a US trustee that is structured as a non-US trust for tax purposes. These so-called foreign grantor trusts, very popular planning techniques. FATCA is part of the US tax code. And so if you have a foreign grantor trust, it's got a US trustee, but it's not a US trust for tax purposes, it's not reportable under FATCA because it's not a US person for US tax or FATCA purposes. But if it is a US trust for US tax purposes, the trust itself is reportable for FATCA.
Okay.
So that's
just Peter, just to amplify that, if I'm the bank, I'm going to talk about the bank perspective. If I'm the bank and I have as an account holder and US trust that it is an FI according to the definition, I cannot treat it as an FI. I have to treat it as a passive non-financial entity and report its account holders, its participants, if they are controlled, if they are reportable persons. So I have to look through that trust. That will be if I am the bank and my account holder is a US trust that is an FI.
Well, yes, case, only.
So sorry. I'm going to put this specific example. I have a US trust that could be considered an FI because it's professionally managed. It has a US trustee, is under US law. But this trust has a participants, residents from Colombia. That is a reportable jurisdiction for Panama. So me as a bank, when I see this trust, and that's why I think that's how this question was oriented. I see this trust, I see it's a US trust. It cannot be treated as an FI trust because it's US. So I have to look through, and then I don't make any report for FATCA purposes. But then if the participants are resident in a reportable jurisdictions, I do have to make a report for CRS purposes.
Yes, the only qualification I would say to that is that for CRS purposes, whether it's a US trust, quote, US trust is not the important. The question is, where is the trustee resident? And as long as you've got a US trustee, for CRS purposes, you have to look through it, even if it would otherwise qualify as a professionally managed investment entity. When you're looking from a FATCA perspective, it's not the residence of the trustee that controls, because you can have a US resident trustee. You can have US governing law. You can have all sorts of things US orientated, but you could still qualify that as a non-US trust for tax purposes. And that's often done by putting
Yes.
a foreign protector in there, and then it wouldn't be a US person.
Just put it in line with the question as it reads. So I can have a US trust that is not a US person trust, and then I have to do my CRS report, but then I don't have to make a FATCA report because the trust is not itself a US person.
Yes, I think that's a correct summary. So you've really got to, in other words, for CRS, you've just got to look where the trustee is resident. For FATCA purposes, you have to classify the trust as a US trust for US tax purposes or not. And that's what will drive whether you report the trust or not.
Okay, so that was one of the questions that was in the chat. Peter, I'm going to translate the other ones, but if you can go forward with the ones that are in English in the chat, in the Q&A part.
I will. So there's a question from Beatrice Marchon. I'm not sure if I'm pronouncing that correctly. Corporate trustees are considered FIs by definition. Well, if they're commercial trust companies, yes, they generally will be. It's not automatic, but it's almost automatic. So I understand we do not need to report them as controlling persons, as they are already reporting independently. Oops, this is switched around now. I can't see that question anymore. Maybe I have to go up. What happened to that question? It's no longer, there it is. Okay.
You got to answer.
Yeah. I got it there now. Okay. So I understand we do not need to report them as controlling persons. Well, you would never report a corporate trustee as a controlling person, because you always report individuals as controlling persons, as they're already reporting independently. Okay. Usually the tax authorities advise that if an account holder or a controlling person is an FI, then we can ignore them in the reporting file, as they are already reporting independently. Is this correct? Well, yes and no. It depends on whether the trust is a passive NFE or is an FI. You've said that the corporate trustee is an FI. The trust might be a passive NFE. If it is a passive NFE, and even if the trustee is an FI, you have to look through the FI for controlling persons. You don't report the trustee in that case, but you would report the controlling persons of the trustee as if they were controlling persons of the trust. If the trust is an FI and the trustee is an FI, you would think, and we actually haven't got to how you report trusts that are FIs, but I'll just give you sort of a heads up as to what's coming. You would think that that would be the end of the story with respect to the trustee. The trustee's an FI, and FIs are not reportable, and generally you don't look through FIs, and you just rely on the trustee to do the reporting. You may not, because again, if it's a passive NFE trust, you would do the reporting. But even if the trust is an FI, there is a rule in the OECD handbook, which comes from an OECD FAQ, that says if your trust is an FI, it must look through all account holders who are entities, regardless of whether those entities are FIs. And that's a rule that is very debatable, and we'll get to it later, but I just want to sort of throw that out there now, that don't assume that if you're an FI trust and your trustee is an FI, that you never look through the FI. It will depend on your jurisdiction's rules, and we'll talk about that more in a little while. Okay, so that's sort of a half of an answer to that question. Okay, so the one, Okay, in Panama, independent trust company have its own GIN, and this way it answers by himself through Panamanian. Yes, okay, so that means it would report. It's not really a question as such. In the AOI Panamanian government portal, an independent trust company with its own GIN is classified as a participating FFI and not as an FFI Model 2 and including USA. I'm not quite sure what that one says. It's classified as a participating
I think
FFI in the
Peter is talking about the classifications in the portal. So the portal, when the portal
Right.
for FATCA in Panama, where you have, where you register, then you have to say what type of entity you are, what type of FI you are. So there are a lot of lines that you could put, but you usually should include the same that applies for your IGA, and is a reporting model 1 IGA. That's what FIs should be registered in Panama, as reporting model 1 IGAs. Did you agree,
Right.
Peter?
Yes, absolutely.
So the question here was, in Panama, independent trust companies have his own GIN. Yes, the trustees have its own GIN, and they have to report to the tax authority. But we have to remember this: trustees does not hold financial accounts. So if you are not going to make a report for a particular trust under FATCA, that you're going to report under the trustee documented trust, then you as trustee only have to send a nil report, because trustees doesn't have financial accounts. So yes, you answer for yourself at the tax authority, but the reality is that as a financial entity, you do not have financial accounts. So if you are not going to perform any report for a trustee documented trust, then you will have to submit a nil return. And then
that's because of a special definition. I just gonna say that's because of a special definition in CRS that defines equity interests in so-called in-business investment entity type FIs, managing, not professionally managed, but managing investment entity FIs, and that's what trustees are. If you look at the definition of equity interests, basically you don't have any. There's some limited exceptions, but you basically don't have any. And as a trustee itself, and therefore you'd file a nil report.
Okay, so I'm going to answer the two of them that are in Spanish. So the first one is, there was a new law that was enacted in Panama that was mandatory for banks that wanted to act as trustees to obtain a license. So what does that mean for FATCA and CRS purposes? Do they need to register as two different types of financial institutions in the portal? I think they do. They do have to register. If they are acting as trustees and they're acting as depository institutions, then they do have to register as both of them, as depository institution and as trustees. So the answer will be that they do have to register in the portal as two separate types of financial institutions: depository institutions and investment entities. I hope that answered the questions of Ana Lorena. That was the first question posted. And then the other question, the last question that we have here is, accounts on the name of trusts that are administration trusts that have a bank account in the name of the trustee are reportable through the trustee? The answer will be, it depends. So here, and I know that Peter, you will agree with this, we need to forget about who is a trustee, and we need to see which is the classification of the trust. If the trust is a passive non-financial entity, then the trustee is not responsible and it shouldn't make any report for that account. The report should be made by the banking institution where the account is held. If the trust is classified as a financial institution, then the trustee, in representation of the trust, can make this report through its gene as a trustee documented trust, and in CRS register the trust independently and make the report. But what I want to emphasize here is that what is relevant is not if the trustee is an FI, because not all trusts of a trustee that is an FI are gonna be reported by the trustee. You need to see the classification of the trust. If the trust is a passive NFE trust or an active NFE trust, the report will be made and should be made by the bank or other financial institution where the account is held. Did you agree, Peter, with that?
I do. I completely agree.
Okay. So, okay, and we are going to finish with this one because we have to move to the other part of the presentation. So, does an asset manager advisor that manage account has to register and send a nil report? Okay, I'm gonna split this answer with Peter, because for CRS purposes, yes. However, asset managers, investment managers in our IGA are treated differently and have a language that says that they are non-reporting financial institutions. And in Panama, non-reporting financial institutions are not obliged to register. So can you please, Peter, just amplify in that, because they are talking about an investment manager.
Yes, investment managers for IRS purposes can be certified deemed compliant asset managers with no registration obligations at all. An investment manager for CRS purposes is still an FI, but wouldn't have any reportable accounts, just like the trustee as a trustee wouldn't have any, because they're not custodying the assets. So I do agree with you.
So the answer will be for CRS, no, because the Panamanian portal has two sections, FATCA and CRS. So for FATCA purposes, you do not have to register, you do not have to obtain a gene. But for CRS purposes, you will have to register and send a nil report, because nil reports are mandatory in Panama.
Laura, we have a question on the chat function. I know we're sort of running short of time, but I do think that we should address it.
Yes, I saw it. It's the last one. It's the last one. Is the U.S. Trust provides a W-9? Is that one?
Yeah, yeah,
Okay.
Saying that it's a disregarded entity. First of all, just to be clear, a trust cannot be a disregarded entity for U.S. tax purposes. It can be a flow-through entity, a grantor trust or a simple trust, but the U.S. tax classification rules do not allow trusts to be disregarded entities. So you better go back to that trustee and tell them they haven't filled out the W-9 correctly. Basically, if you get a W-9 from a U.S. trust, again, for FATCA purposes, regardless of whether it's grantor, simple or complex, it's a reportable U.S. person, and you wouldn't be looking through it for the beneficial owners or the controlling persons, or however you want to characterize them. So whoever's got that question, it seems like you've gotten a faulty W-9. Trusts cannot be disregarded entities. Companies can be, trusts cannot. Laura?
Yeah,
Okay.
I was not able to unmute myself. I'm sorry. So we are moving to the next part. This is a shorter part, and we are also going to allow you to make your questions and leave a smaller part of the section at the end for the answers. Okay, so we're now going to talk about banks, as one of the questions that we had was, what happens when bank is also the trustee? So that will be the second part of our presentation. So what has a bank has to do when it is a trustee? So first, the bank will have to classify their trust, even because their trustees have to sign some certification for the same financial institution, or just because best practices, if you have trust as a client, you want to know how are they classified for FATCA and CRS purposes. So the first part that they should do is identify in all the trusts that I have as trustees, which are passive, which are active NFEs, which are financial institutions. And then I know all the trusts that I put in a basket, all these trusts are non-financial entities, either passive or active. The bank maybe is the same financial institution that acts as trustee, but as a bank, they have the obligation to perform the report, or any other financial institution where the trust holds an account. But if the trust is classified as a financial institution, well, there is two options. The trust itself can be registered for FATCA and CRS purposes, or the trust can be treated as a trustee documented trust, and the trustee has the obligation to register and report on behalf of the trust all the accounts that are reportable for that trust as trustee documented trust. But the report is of the trust account holders, because the trust as a financial institution has its own account holders. So as Peter mentioned earlier, and I think we discussed it a little bit, was what does it take for a trust to be classified as a financial institution of the type of investment entity? And well, the first one is that the assets, the financial assets, need to be managed discretionarily by another financial institution. And Peter already talked about the different positions that we can take on this. And the second one was that at least 50% of its income must be attributable to financial assets. So a trust that does not have financial assets can never be treated as an FI, because it won't matter the first point. They are not going to comply with the second one. And for you be able to be classified as a financial institution, you need to comply with the two criteria described there. So this is a wording from Panama's regulation that is not included on the CRS, it's included on the commentary. But Panama decided to include it in the regulations as mandatory. We are going to talk later about this, but Panama does not, as other jurisdiction, does not make reference to the standard, does not make reference to the commentary, does not make reference to the Q&A published by the OECD. What Panama wanted to be a regulation is included in the regulations. And this is an example. This wasn't the commentary, not on the standard, and Panama included this language to give a little bit more clarity on what was being managed by, what was the managed by test. And it means that if the trustee has no discretion to manage the entity's assets in whole or in part, then the trust cannot be deemed to be managed by the trustee. And Peter, I don't know if you want to comment a little bit more on this, that we already discussed, but that could take two different approach on what is the managed by test.
Yeah, I mean, it harkens back to what I was saying earlier, which is that if you look at the language there, it says if the entity has no discretionary authority to manage the entity's assets in whole or, it doesn't say investments, it says assets. Now, some people read that language to mean investments, and I actually think that's what they intended. And so that if the trustee doesn't have any investment powers, in the trust deed itself, it says the trustee doesn't have investment powers, they are reserved to the settlor or they are given to someone else in the deed, then you can take the position that this requirement is not met unless the person who has the investment powers delegates them to another FI, for example, by putting them in a bank account that is discretionarily managed. The other position, equally valid in my view, is that assets is not coterminous with investments, and that a trustee always has discretion to manage the assets because they own the assets legally. They get to decide. They have an obligation to insure them if they're of a certain type. They may get to decide whether to distribute them in kind. They're not just holding them in as a nominee, so they have authority to manage them in a broader sense. And again, I think either option, either interpretation is reasonable. If I'm representing a trust company, and I represent a lot of trust companies, I like to take the position that if you've got one of these deeds that reserves powers to the settlor, then I think, and in fact, in some countries, the guidance actually says this, that if that type of a deed, then you don't meet the professionally managed by test just because the trustee is an FI. And that's good because then the trustee wouldn't be responsible for reporting if the trust is not an FI.
Yeah, and I just wanted to comment on a very typical type of trust that exists in Panama, and is that the trustee holds the shares of an underlying company that has a bank account, but holds these shares almost as a custody because the trustee doesn't have the voting rights. These are reserved for the settlor. The trustee has no discretion on how distribute the assets that will be the shares of the company to the beneficiaries. And the trustee doesn't have any control on the bank account. That is done by the client or the settlor. So in this type, the trustee basically acts as a custodian of the shares because it doesn't have any management. So in these types of deeds that are very specific, saying the trustee doesn't have voting rights, the one that is deciding how the benefits going to be distributed is the settlor or the protector, then the trustee basically doesn't have any management of the assets. So this is very common in Panama, and this is what I think that this is what you will say, that the trustee basically acts as a nominee probably, and then it's probably going to be a passive non-financial entity trust because the trustee really doesn't have any powers to manage the assets.
Yeah, I mean, I think as a matter of trust law, it would be what's called a bare trustee, which in effect is a sort of a nominee. But yeah, no, I do agree with you, wholly agree with you.
Okay, so yeah, here in Panama they call them like a custody trust because they are the custodian of the shares because they have the title on them, but they cannot perform any function with regards to the administration of the assets. So I'm gonna pass to the next slide. And yes.
Okay, so now we're really talking about, well, who are the account holders if the trust is an FI? So previously we saw if the trust is a passive NFE, who are the controlling persons? Controlling persons are relevant only to passive NFEs. And a lot of people get the terminology mixed up and they say, well, who are the controlling persons of an FI trust? FI trusts don't have controlling persons. They have account holders, and that's defined, as it says on this slide, as debt and equity interest holders. Debt holders, that's not defined in CRS or in FATCA for that matter, but it's generally understood to mean lenders. So somebody who's lent money to the trust would be a debt interest holder, not where the trustee has lent money, but where the trustee has received a loan. That would be a debt interest holder, and reportable if they're in a reportable jurisdiction and otherwise a reportable person. But what we mostly see are the equity interest holders. And who are the equity interest holders in a trust? And that's what this slide addresses. It's interesting because the definition of an equity interest holder in a trust was based on the definition of a controlling person, but some changes were made, and very significant changes were made. So, for example, when you look at them, and I've got a slide later on, it's the next slide, side by side, you'll see that while protectors and trustees are listed as controlling persons, those words were taken out of the definition when the drafters came up with a definition of equity interest holders. So maybe, Laura, can you advance to the next slide and we can compare those two definitions?
Yes, of course.
There. So on the left, I've got the controlling persons of a passive NFA. Trustees and protectors are expressly listed. On the right-hand side, we've got the equity interest holders in a trust that's, I've got IEFI, which investment entity, in this case, professionally managed investment entity, FI. The definitions are almost identical, except that the words trustee and protector were intentionally deleted, which makes sense. Trustees don't have any equity interest in a trust, and neither do protectors. However, the OECD sees things differently. And they have come out with an FAQ. It says all protectors are equity interest holders in trusts. And they've come out in the handbook and they've said that trustees are equity interest holders in trusts. And honestly, I think that's rubbish. Both of those positions are total rubbish. Now, if you happen to be in a jurisdiction, Panama is not one of these jurisdictions, thankfully. But if you happen to be in,
we're not.
no, you've used some common sense and you've retained your sovereignty. But some jurisdictions have said you must apply the CRS implementation handbook and you must apply anything that the OECD says. And if you're in one of those jurisdictions, then you have to treat protectors and trustees as equity interest holders. If you're not, if you're in Panama, then you don't. You just go back to the definition of account holders. And there you'll see that the only possible way that a trustee or a protector could come in as an equity interest holder is that language at the end that's in bold. Any other natural person exercising ultimate, effective control over the trust. Now, there was a question earlier where they said, well, what if the trustee is an FI? Don't have to look through them. Well, that's not the OECD position, because in the handbook, they actually say trustees or they say trustees, first of all, are equity interest holders. And in the FAQ, they say protectors are. And they say that any entity that's an equity interest holder, any equity interest holder that is an entity, you must look through and treat the controlling persons of that entity as the equity interest holders. Now, I think that's nonsense because they've confused two concepts. Go ahead, Laura.
Yeah, I just wanted to jump in and tell you, if you follow the standard and what it says, and the trust is a financial institution and has account holders, and your account holder is, for example, and imagine that the account holder is a protector that exercises control, or a trustee that does exercise control, so you are going to include it in the account holder part. Either way will be the same as a bank. You have an account holder that is classified as an FI, so it's a non-reportable person. That will be when you follow the due diligence and report part of the standard. So if you do that, you are going to come to the conclusion that my account holder is a financial institution, then my account holder is a non-reportable person, thus this is a non-reportable account. So ignoring the Q&A of the OECD and following what it was approved by the Global Forum, that it is the standard and the commentary, then you cannot come to the conclusion that you need to see through these trustees or protectors if they are NFIs, because as simple as it goes, is an account holder that is a non-reportable person. I don't know if you see it that way also, Peter.
No, I see it that way in terms of reporting the entity itself. But what the OECD has apparently done is they've taken that language at the end and said any other natural person exercising ultimate effective control over the trust. And they've looked at that and they've said, well, if you've got an entity, you have to still look behind, are there natural persons exercising ultimate effective control? Well, the reality is that I can see where you would look through an FI to determine, are there natural persons behind there exercising ultimate effective control? But in my experience, there won't be a single person at a trust company that exercises ultimate effective control over the trust. Usually decisions are made by committee. Protectors, in my view, should not be generally treated as exercising ultimate effective control, because if they're exercising ultimate effective control, it basically means the trustee isn't, which means it's basically a sham. So what the OECD has done is and by the way, the language is exercising, not has the power to exercise, but present tense, they are exercising. So even if the protector had a power that it could exercise, I don't think it would meet this. But instead, the OECD said, just look through and find the controlling persons and treat them as controlling persons, as equity interest holders. So for example, if you had a trust company, more than 25% shareholder would be deemed to be an equity interest holder under this FAQ, even though as say a 26% shareholder, they have no control at all, let alone ultimate effective control. And even though they aren't exercising anything. So I don't want to harp on this, but I just say, if you're not in a jurisdiction that requires you to follow the OECD FAQ and handbook, then you should ignore these ridiculous attempts by the OECD to change the rules in the middle of the game. If you're in Panama, don't report trustees, don't report protectors unless you are convinced that they are exercising ultimate effective control.
Just to sum up that part from a Panamanian law perspective, so and from an international perspective also, the common reporting standard and the commentary, as you know, Peter, was approved by the Global Forum, where all countries that are participate. So for example, Panama has a representative that go to these meetings and approve the common reporting standard and then approve the commentary. But then this Q&A published by the OECD was not approved by the jurisdictions. That is the international part of it. Was not approved by the jurisdictions. So how can we abide by something that we didn't approve? We weren't there. We don't know who answered those questions. It wasn't discussed. This is the first part. And then the second part is that Panama, as a civil law jurisdiction, we do not make reference to international standards. We copy the international standards in our law, we translate them to our law, and we are only obliged to comply with the law says. So if the law doesn't change, then as Peter said, we are not obliged to comply with this change that was made in the middle of the way. If the rules are going to change, they have to change to the proper channels. So I think that we were in this slide, Peter, and then we went to the other one just for city definition. So
well, I think we've covered the first two bullet points. Who are the controlling persons? One other point, I would just say that not only are you not obligated to follow the handbook and the FAQ in Panama and other countries, you're not allowed to the extent that they contradict what CRS says. And if CRS says that an equity interest holder is a beneficiary that gets a distribution, is a settlor, and any other person exercising ultimate effective control, and you ignore that and you report a 25 or 26% shareholder of a trust company or a protector company, or you report a protector that isn't exercising ultimate effective control, you've actually violated local law. You maybe think
Yeah.
you're doing right by complying with what the OECD says, but you're not. And I think the tendency in a lot of jurisdictions is for trust officers and bank officers to just take the OECD documents as if they are Bibles, and that's just wrong. Look to what local law says, follow local law.
Yeah, and just to make a final comment on that, because we are a little bit behind time, there's an important part of Panama jurisdictions that says that the financial institutions can only waive the confidentiality duties that they have to their clients in compliance with the law. So if you make a report that is not in compliance with the law, that is against the law, then you are violating your obligations of confidentiality to the clients because you made a report that was in non-compliance with the law. So you may be, as a financial institution, be subject to sanctions because of this, because you are violating the confidentiality in a way that you were not allowed to, because you are only allowed to, or this confidentiality is only waived if the report is done in compliance with what the law says. So I think that we can go forward. I just wanted to close that topic with that, and we can go forward with the rest of the slide.
Okay, so the third bullet point is just where is an FI trust resident, and it's resident where the trustee is resident unless it's tax resident in another participating jurisdiction and reports there. But most of the trusts we deal with and that you deal with won't be tax resident anywhere. So essentially it comes down to, if it's an FI, it's resident where the trustee is resident. Forget about where the governing law is. That's where it would have its reporting obligations. And then for discussion, who's really liable for the obligations, the trust itself or the trustee? Well, the trust is, unless it's a trustee documented trust, in which case it shifts to the trustee. But essentially the trust can't act apart from the trustee anyway. So it's a bit of an academic question, is who's liable. The trustee is always going to have to be fulfilling the obligations.
Yeah, that's what I think. Like, even if it's not a trustee documented trust, who else is going to represent the trust? As who else is going to act on behalf of the trust if it's not the trustee? So the trustee is the one that has this obligation to report on these trusts that are FIs. So the second question is a practical one. How can a trustee report a trustee documented trust under CRS if the portal only gives this option for FATCA? Unfortunately, the portal of Panama doesn't have an option to treat trusts as trustee documented trust, meaning that you do have to register each trust that is an FI independently. So this is probably a good option because as I was discussing with Peter, there were some changes in other jurisdictions that already make the process more difficult when you include the check the box for trustee documented trust under CRS. So for now, you need to register each trust that is an FI individually for CRS purposes. For FATCA purposes, you can register them under the umbrella of the trustee. This is a practical matter of the portal. And the last one is, what happens when the bank acts as trustee? And I think we already answered this, Peter, because it was a question. What happens when the bank acts as trustee and is also the depository institution? Does this have two different obligations if the trust is an FI? Well, the answer will be yes, because you have to document the trust as an account holder and reach to the conclusion that it's non-reportable because it's an FI, and then you as trustee has to perform the report for FATCA and CRS purposes in representation of the trust. So the answer will be yes, and I think we discussed it in length when we answered the question that was posed in the Q&A. So I think we already went to, we already went to this one. So Peter, there is one question in the Q&A part, if you wanted to take it.
Yep, I'll take it. First of all, hi, Jose. Hope you're doing well. So if the trust holds financial assets in street name, I'm not sure that it really changes anything. It's still holding those assets on behalf of the entities, and so it would just treat it as if the entities were holding them, and you'd classify it accordingly. I don't see how that would really change anything, whether it's in street name or whether it's in the trust's own name. In substance, we've got the same situation. So unless I'm missing something in your question, Jose, I think you would just follow the normal classification rules. And if the assets that it holds for one trust in street name are financial assets that are producing more than half the trust's income, and if the trust is otherwise professionally managed, it's a professionally managed investment entity, FI.
Yeah,
But
Peter, I think
I'm
at
not,
the end of the question asked what type of FI will that trustee be?
right.
So
Well, I think
if so if the trustee doesn't have any accounts that it manages discretionarily, would you think it would be an FI or it wouldn't?
no, if there's no discretionary asset management, and we don't, we fall back onto that question as to whether the trustee has investment powers. If the trustee doesn't have investment powers and there's no discretionary asset management, then it wouldn't be an FI. But I guess that's the question. The question is, what type of FI would the trustee be? Exactly. Would it be, for example, would it be a custodial FI? And I would say no. Because in order to be a custodial FI, you have to get 20% or more of your income from fees for acting as custodian. And in this sort of a situation, I dare say the trustee generally won't be charging separate fees for acting as custodian. It would just be charging trustee fees.
Yeah, and so Peter, I just wanted to clarify, even if the trust, as I said to you, these trusts that are named like custody trust, really the trust does have the title, so it's different from a custodian. You're not doing any custody because you do have the title and you are really the owner of that asset. So I don't know if you can treat that as custody, as the definition of custody is in the standard.
Well, and even if you can, again, I don't think, unless you're charging fees for the actual custodying of the assets and you meet that 20%.
Jose just posed the question that if even imagine that the threshold is met, but as I said, there is a legal difference between a custodian and transfer of title in a trust. So I don't think that even if the 20% threshold is being complied, it's not custody fees what you are charging. You are charging for fees for a trust. So I don't think in any case you could treat the trustee as a custodian.
Agreed.
Okay, so we are done with the questions. Thank you all. You have on the screen contact information for the ones that ask for Peter's website. I invite you all to get on the website, to subscribe, to get all the information. There is very good information specifically in trustees and how trusts and how laws are changing in many jurisdictions. For the ones of you that handle lots of jurisdictions, then you will have a very good hand tool there to get all your information. So I invite you all to get in Peter's website, subscribe, and get all the information that he's publishing ongoing all the time. So I'm going to pass the word to Giovanna, that is going to make some conclusions on the presentation.
Thank you, Laura. First of all, on behalf of the International Fiscal Association Panama branch, we would like to thank Peter and Laura for this brilliant presentation. We are very much satisfied with the lot of information that you have provided us this morning. And before we finish, I would like to emphasize that when identifying account holders, trusts, should be treated as entities, and therefore a self-certification of the trust could be required. Second, that controlling persons of passive benefits trust must be identified and reported. That is important to pay attention on the main concepts such as reportable person, reportable account, and reportable jurisdiction persons. And finally, to understand that from our local laws, a controlling person may be a trustee, a protector, a beneficiary, or any person that has effective ultimate control over the trust. This is very, very important, as Peter mentioned. Thank you very much once again. And it's my time to pass my words to the president of the World Compliance Association, Tabaré Albarracino. Thanks.
Gracias, Giovanna. Gracias, Peter, y gracias, Laura, por excelentes presentaciones. Gracias a IFA por hacer posible este primer evento del Comité de Compliance Fiscal de la World Compliance Association Capítulo Panamá. Y, por supuesto, a la Asociación Bancaria por creer en la realización de este evento. Los invitamos a que sigan viendo nuestras redes de los próximos eventos que realizaremos en conjunto. Y muchas gracias por su participación. Saludos.
Los invitamos a abrir cámaras para tomar la foto final. 2 segunditos, gracias. Y nos vemos en la próxima.
Thank you all.
Bye, Peter. Bye, Laura.
Thanks, everybody.
Thank you, Michelle.
Thank you.
You're a
Bye,
rock star.
Peter.